Hey, I'm Dave,
And I'm Paul.
and this is the Wealth Warehouse Podcast. All right, everybody. Well, welcome back to another live Wealth Warehouse webinar, June 2025. So, hope everybody's summer's off to a great start. It's already almost half over. I mean, June anyway, not summer. Actually, for Paul, for your son, it's almost half over.
Yeah, they go back to school the first week in August. They
He's
get
got the world's shortest summer.
They get a
this
short
year.
summer this year.
Poor guy. Yeah. But all right. Well, hey, we got a few of the usual suspects on the call on the webinar today, and some new ones. I see Tammy showed up. So, Paul, you brought your wife along. Well done. Hopefully, she's got some really good, hard questions for you.
She was actually giving some sound advice to somebody, and I think I'm going to bring that up real quick to open up the webinar, that question, because I think, some of our people on here will have their opinion on what they should do. There's really no bad choice, I would say, though.
Well, why don't you go with that, and then we'll cover a topic we had in mind, and whatever questions come up from anybody else.
Yeah, so we have this client that, and she's a friend of ours. She's an Army Nurse Corps officer, like Tammy. They've been friends for years, and they're clients of mine. So she sends me a text. She just moved, just PCS'd, and to this area here in the National Capital Region. Anyway, so this is her situation. She's got, she's married, got a husband, child. She's got basically a $40K premium coming up at the third week of this month. She's got the money sitting in her high yield savings account, ready to pay the premium. She's got, a credit card debt to pay off. That's pretty significant. Usually when we move, we swipe the card for all kinds of just stuff. It's a high cost time when you move in the military, and then you wait to get reimbursed. Anyway, and then they're going to be running a split household for a while, so they've got basically a mortgage and now new rent. So kind of like two households, right? So her question to me was, how do I juggle these glass balls? And it's a temporary problem, right? He's going to move out there in about 6 months, and they'll have one household again, and they'll rent their house out there, no problem. So it's a temporary problem, but she's asking, this is a sequence of money question, I think, right, Dave?
Yeah.
Yeah.
Right.
So we talked about, I actually asked ChatGPT, just out of curiosity, what it would say, and it said you should prioritize the premium. And you've heard us say that on this podcast, probably. Prioritize the base, prioritize the PUA, and then work on your policy loan. But in this case, it's a credit card bill. So option one is she could pay her full premium. They've got 3 policies. They've got a couple years of premium in there, so they have plenty of cash value to handle all of this, right? So she has the cash to pay the premium. She could take a policy loan to handle the credit card, and then just pay off the policy loan, right? That she paid the credit card off with. No problem, right? Or, Dave and I were talking earlier, she could just pay the base premium plus the $120 PUA rider fee, basically, to keep it active, and use the remaining cash in that high yield savings account to pay off the credit card. She could do that as well. And we came to the conclusion that it's kind of just splitting hairs on what is better. I think a lot of people would feel good just taking the cash and paying off the credit card. Not the end of the world. And then just taking the money that you, from a cash flow perspective, she's got the cash flow. She can just pay the PUA periodically throughout the policy year. And there's nothing wrong with that. So anyway, anyone have any thoughts on that?
Yeah. My only thought, and you and I were discussing this, is that assuming that, they're at the beginning of the policy year. So yeah, pay the base premium, get that out of the way. You got that fully funded right away. You can pay the PUA anytime throughout the year. Assuming they'll be able to maximize that PUA later in the year.
Yeah.
And take care of their expenses today, that credit card bill and some moving expenses and everything like that. Then I don't see, kind of splitting hairs between paying the PUA right now or just get it in later. As long as you got it in before the end of your policy year, I, I think you're going to be fine, right? Just maximize that. And a lot of times it may be emotional too, where maybe emotionally they'll feel a lot more settled if they just fund the base premium. They got that taken care of. Cool. Check that off. Now we're just going to just get rid of this debt, not carry any balance on the credit card, any statement balance. So we're not paying any interest to somebody else's bank. And we got that off the books. Okay. Now we can breathe. We feel good. Now all we got to do is fund the PUA. And as we can, whenever we can throughout the year. I mean, when they get that big check after they move for the partial Diddy move or whatever, then, hey, this is great. We got a big chunk here. Let's throw that towards the PUA.
Yep. Yeah, we talked about that. So anyway, just, these are the kind of questions that come up with clients sometimes. Everyone's got different things going on. And, I think she's got two good options, really. There's no bad choice here. Her dividend that she'll get in policy year 2 is, if she pays her base premium, we've talked about it, right? Most of the dividend is paid off base premium on these policies. Very little is actually paid off the PUA. So anyway, all right. Yeah. Moving on.
Hey, Steven threw a question in there. We can always count on Steven to throw some questions out. Good. Well, are you able to come off mute and expand on that one?
Can you hear me now?
Yep.
Yeah.
Oh, okay. Gotcha. Yeah. So I have a question, just kind of got my policies in place in the last couple of weeks. And you've referred to the book before, Dave, Garrett Gunderson, using trust to pass wealth down through the generations. And verses in that book talking about the Vanderbilt family, how they've lost all of their wealth, whereas the Rockefeller family was able to perpetuate their wealth using whole life insurance and trusts. I had a trust in place, and I went back and talked to them because the entity that set up the trusts, they said that they can make alterations for free. And I kind of proposed to them using whole life insurances and purchasing plans for subsequent generations. And they jaw dropped. They had no idea what I was even talking about. And I kind of equated it to talking to just a regular life insurance agent trying to set up a whole life policy to be structured to take kind of, infinite banking, become your own banking concept type payments and PUA and stuff like that. So I was just curious, because you're in the realm of, even in the becoming your own banker book, there's the even distribution of classes, and Nelson Nash has talked about when the eldest male kind of in this new series of setting up life insurance policies and setting them up on grandkids and children and spouses and all that kind of stuff. It kind of becomes a complete circle when the eldest male dies. And so kind of getting into this now, I would be the oldest male and likely the first to die. So how do I control the rest of my family getting these life insurance policies after I'm dead, outside of just educating? Is there trust attorneys that you guys know of being in this realm and thinking long term that you guys refer clients to frequently? If all of that makes sense, or I'm just rambling on and nobody knows what I'm talking about.
No, that makes sense. I understand what you're saying. Yeah, first off, neither of us are trust professionals. Now, we do have a good number of clients who have, say, revocable living trusts, and they make the beneficiary of their policy the trust, which makes a lot of sense. And then you can direct the trust to do whatever you direct the trust to do when the trust receives that death benefit after you graduate. And I'm not, I haven't gone through that full estate planning process myself. I don't know if anybody else here on the call wants to give some feedback on anything they've done. But plenty of people use those to accept the death benefit as the beneficiary. There's something with, it's still going to be in your estate. So keep that in mind. If it's a revocable living trust, if it's an irrevocable living trust, that's the only way I believe you can get that death benefit out of your estate, so that it's not part of your estate for estate tax purposes. And if you do that, there's some other complications with putting a policy into it's got to own the policy. You put that into an irrevocable trust. You can't ever take it back out. And it's got to be in there for at least 3 years before you graduate for it to not count as part of your estate. Now that, working with those and being able to access the cash value and all that kind of stuff from an irrevocable trust, that would require you talking to a trust attorney, somebody really well versed in that, and somebody really well versed in not just setting up trusts, but who understands life insurance as well.
Yeah, I know what you're getting at, Stephen. You don't want to control the money from the grave, but you want to make sure that the perpetual wealth system just keeps going, right? Because they often say, like, if you think back, how many generations? I remember my great grandmothers. I had two of them. I remember my great grandfathers were dead, but I remember them. But beyond that, I didn't know anybody, right? And they're gonna forget, right? We're all gonna be unfortunately forgotten someday, unless we can figure out this kind of Rockefeller method. And I think there is a way, to kind of control what happens, at least with a portion, let's say, not all of it, but a portion of the death benefit that gets moved on to generation 2, generation 3. But it's all about, it's going to start with us, right? If we're going to be if we, let's say in our circumstances, are the leaders of our families, let's say, right? It's up to us to inculcate that culture into our family, and then our grandchildren and great grandchildren, maybe, like, this is how the Clarks do business. This is what we do. So I guess in short, we owe you an answer on maybe an attorney, somebody in our network can recommend that really understands what you're trying to do. Because to me, what you're trying to do is quite simple. I don't know why they're looking at, it's.
Yeah, it's just perpetuating it past, because it seems like from just the few that I've talked to, they're like, figure out how to get the money to the next generation, maybe spread out over a 10-year period of time. But outside of that, the thought of doing anything longer than a 10-year period of time, kind of like the Rockefeller method talks about in the Garrett Gunderson, what would the billionaires do? What would the Rockefellers do?
Yeah.
The thought of just doing that is just like mind-boggling to some of them. So I was just curious, if anybody knows anybody who can set up a Rockefeller type trust situation like Garrett Gunderson talks about in his book, so that, the Clark family doesn't turn into the Vanderbilt family and all the wealth is gone in 3 generations.
There are some rich Vanderbilts still, though. The ones, they actually own the Biltmore still. And then you have, what's his face on TV there?
Anderson Cooper,
whose mom was a Vanderbilt. Anyway.
Hey, Stephen.
Yes.
On our trust, I'm going to be careful. I'm not going to say any companies or names, but a simple document I made out is life insurance policies and final instructions upon graduating this life. And I wrote all of our family's policies, starting with mine, of course, all the way down to my grandson. And then contact Dave and Paul, and also have some friends in East Texas involved in some ministry stuff who happen to also be IBC practitioners, so that my family has a network there. And I simply wrote a few little lines on instructions on how I wanted them to take, because it's a significant amount of money, and how I wanted them to put them in PDF writers for at least 10 years, to kind of stair step down.
Yeah,
I'm
I had
lucky
the same
my
thought.
son, he's wise enough to start getting this, and even my youngest son at 18, and then my daughter's fixing to be 22. So they're old enough to understand. They thought I was crazy when I first started this, but they're starting to see some of this, And anyway, Paul's right, though. It kind of starts stair stepping that. And then here on the end, just a personal little letter, if you will. And that little letter, kind of a family crest letter, so to say, will mean more to them, hopefully, when you go to pass than any of the money will, right? And that's just a good way to start. And once I presented that, now I had one lawyer for sure that was a knucklehead, but there's a few out there that are willing to open their minds up, if you will. And I'll be careful what I do here, but I'll reach out to you with some stuff, and obviously Dave and Paul will as well.
Great, thanks,
Good.
Wes. Yeah, if you guys want to connect in the chat right here, feel free
Sweet.
and get your contact info so you guys can connect on that offline. But yeah, maybe that's we've got access to somebody at one of the companies that we write for who is kind of an expert in that field too. An attorney, an esquire, I guess that's how they sign their name, so and so Esquire. That could be a really good source, and I've talked with her a couple times on some of this stuff. But maybe we could get that'd be a good podcast episode, huh, Paul? Get like
Yeah, it
a
would.
trust attorney.
I want to caution people, though. For the most part, everyone here that's in this room, your policy should be personally owned and personally controlled for those reasons Dave talked about, earlier. You don't want to complicate this, right? So it can be the beneficiary, that's fine, but you want to make sure that you maintain control, right? Because you introduce complications, you might cede control, and that's one of the reasons that we're practicing the infinite banking concept is control over capital. We don't need another gatekeeper in the way of us and our money, right? Where you have the IRS and banks and whatever. We don't want another one. So just make sure you keep that in mind, the control aspect. You want control.
Yeah, I think.
And you sacrifice some things to have control, though, right? So.
Yeah, there's probably cases for trust owning the policy, and like I said, one of them would be estate tax purposes. For a trust to own a policy that will create enough cash to pay your estate taxes for you, so your family doesn't have to liquidate a bunch of assets or something like that,
Right.
or do a fire sale to get the Uncle Sam the money he's stealing from you within 9 months of you passing, while people are still mourning your loss. He's saying, "Give me my money," and it must be in cash, and
Right.
in $100 bill denominations, unmarked.
Right.
So, but that could be a good reason to have a policy owned by a irrevocable trust.
Yeah.
Yeah. Other than that, I'm not qualified to speak on much more than that with regards to estate planning. But that's a great book, man. If anybody's listening who hasn't read that book, What Would the Billionaires Do, which is what it's now titled, it's a great one. Open your eyes to generational wealth and keeping that going perpetually. All right. Any other questions off the bat? And if not, we'll discuss a topic we have in mind. All right. Well, one of the biggest things that we get questions on from clients after the policy is in force is, I always tell people, hey, anytime you have a big financial decision to make, just schedule some time with me so we can talk it over and just run it by me. Just, I'm a second pair of eyes and ears. I have hundreds of clients, and maybe I've had this discussion with other people and can think of something maybe you haven't thought of yet. So I get calls every once in a while, and a couple lately have been, hey, I'm looking to buy a new car. I've got enough cash value to pay for it, but there's also car financing that I can get a pretty good rate on. What should I do? So I don't think there's a black and white answer to that. So I'm curious to know what anybody else here has done. If you have purchased something and strictly just use your cash value to finance that purchase, or if you've actually used financing instead of cash value, even though you have it available, and why you did that. I can start. 2 years ago, I bought my wife a car, and I had the cash value to pay cash for it, but I decided to finance. And the reason I did is because I wanted my cash value available. I wanted my capital available for other opportunities that I was looking at. for other opportunities to put that money to work to make more money for me. So I financed the car, and then Paul and I, this is about a year and a half later, Paul and I are at the think tank together, the IBC think tank, and I'm looking at this again, and I still have cash value available, and even more than I did 2 years prior, a year and a half prior. And I'm thinking, I don't need all of this available for an opportunity. Why am I still paying interest to somebody else's bank with this car loan? It served its useful purpose. And its purpose was for me to have more cash value available for opportunities. But I decided not to pursue them. So at that point, I made the decision, I'm just going to pay the car off. So I just went online to the bank and took a loan, went online to the bank, made a payment, paid the car off, own it free and clear now. And I even did the calculation on the interest, because you can look at an amortization table for even your car loan and you can see what the daily interest amount is. And I compared that with the daily interest I'd be paying to my insurance company. And it was slightly less paying to the insurance company, but that interest going to the insurance company is adding to the profit from their general portfolio. And that profit gets returned to me as dividends. And every dollar I pay back towards that loan is available for me to use again because it's going towards the principal. So ultimately, I made the decision at that point, I'm better off taking a cash value loan to pay this car off and redirect those payments back towards my policy, repaying that loan. So I just bring that example up because there's not a one size fits all answer, and it depends on your current situation and what do you need to have capital available for. And as Paul and I always say, when you're the banker, you can do whatever you want. You have the power to make that choice. I can do this or that. Which one is the best for me right now? Knowing that maybe 6 months, a year and a half later, your priorities may shift and you can just pay it off. So what do you have to add to that, Paul? You've done that too, right? Where you had the cash available, but you chose to finance instead.
I'm doing it right now. I've been doing it I bought the Hellcat in 2021, and then I bought the Cuda in early 2022, right? Or 23. And whatever. It doesn't matter. The point is, in my particular circumstances, right? If you're building a home or you're going to have the potential to have a large outflow of cash to meet some need, you need to keep as Stephen here put in the chat, you need to keep your powder dry, right? So I'm a big fan of keeping my powder dry. I still have those 2 car payments. I make them every month. It's fine. It's no problem. The interest rates are terrible because it was, interest rates were high when I bought those things. But I don't care. And, so when we move to Tennessee, the dust settles, I'll reevaluate, kind of like Dave did 2 years later. He reevaluated, and like circumstances have changed. I don't need all this liquidity. Let's start to flow money back to a company that I own, right? The life insurance company. And I'll swap out those loans. I'll get the title in the mail from, I guess, USAA, right? I'll own the vehicles. They'll be mine, right? And then I can, do whatever I want with them later. So yeah, it's not really a bad choice, right? Like, you're going to give up some liquidity by trading out those loans, right? I'm going to take policy loans. I'm decreasing my liquidity in favor of control, in favor of paying interest to something that I own as opposed to the bank where I'll never see it again. So, that's the beauty of IBC, right? Is when you practice this and you are very liquid, you have choice, and you can peacefully and calmly just sit there and be like, well, I'll do this at this point in time. So you can really plan ahead and make, strategic decisions that work for you in your situation. So yeah, it's great.
Yeah, so, because when you have the cash to pay something off, it's the same as having it paid off mentally. Like I can pay it off when anytime I want, but it's serving a purpose for me right now to keep my capital dry. And there's a value in having available capital.
Yeah, there's some psychology behind this. We have a friend here that has a ton of cash, not a client. All the cash is in the wrong place, and they've been saving it to try to buy a house up here, which is a very competitive market. It's, like we sold this thing on Facebook, this house that I'm sitting in. That's how easy it is for top dollar, right? So they haven't been able to buy a house. They're sitting on a ton of cash, and I'm just like, and the reason is, and think about this, because you hear me talk about this all the time, is they don't want to have a super high mortgage payment. And I'm like, well, you can handle that payment. Otherwise, you wouldn't be buying a house that is that expensive. Wouldn't it be better? I know everyone would. I would rather have that money in a series of whole life policies that I own and control. The minute I give it to the bank as a down payment, let's say it's $1.5 million house and I put $1 million down. Well, I just locked up $1 million. Maybe I can get a HELOC. Maybe I can't. And the HELOC rate's going to be like 10%, maybe. Right? It's not going to be. My HELOCs are terrible. They're like 12%. Terrible. So anyway, I think there's that psychology, Dave, behind it when one, a lack of understanding of this whole life product. They just don't understand like you could use it like this. But yeah, I'd rather have that money under my control.
Absolutely.
Who else?
Yeah. Anybody else financed anything with their policy yet?
Some of you have very junior policies, so
Sure.
that's okay.
Yeah. You're in the capitalization
I have
phase.
junior policies, but having that cash and peace of mind, it's a game changer, like you guys said. And I'm still swinging some bad debt, admittedly, right? We had a situation with the house and the remodel and all the things that happened. So it was a pretty big blow. But I don't worry about it anymore because I have things in place now that even if I go tomorrow, this thing's going to automate itself and run it, and my family's going to be okay, and they'll squash it immediately. So just having that peace of mind is everything. Totally changes your air about you in everyday life. Financially, knowing that you got that cushion.
Yep. Nice. Yep. And another Paul says he bought his son a truck and a furnace. So look at that. I'm assuming he didn't just want a new furnace. He probably needed a new furnace. And hey, dad stepped up with the family bank and said, I got you, son. Your family doesn't have to freeze this winter. So, yeah. Nice. Anything else on that one? Like just financing things. It's just, yeah, it's a nice peace of mind knowing, oh, here's what I wanted to say. Let's say you decide you're going to go get a new car and you're going to take a cash value loan. You made your decision. That's it. I would still, before you buy that car, ask them, hey, do I get a better price with cash? Or what kind of financing deals do you have?
Yeah.
I don't remember the last time I walked in somewhere and they wanted cash, where they said,
They
yeah,
don't.
we'll give you a discount with cash, like Dave Ramsey says. Yeah, walk in with cash and you're treated like, no, they don't care. They make money on the financing.
Yep.
Let's be real.
They're finance companies that make cars.
Exactly. The sell
That's
cars.
what they are.
Yeah.
Yep.
Exactly.
That's what they are.
Right. Just like you said, Tesla is a software company that makes cars.
Yep.
Yeah. But we have a client, or I've got a client, and he was on the show, and I'm sure we've mentioned it before on the podcast, but he walked in fully intending to pay cash. He even had the money in his bank account because he took the loan ahead of time and he had it ready to go to stroke that check. And they said, well, here's the price if you pay cash, but if you finance it, you're going to get like $2,000 off the sticker price. And if you finance at higher rates, maybe you get even more off. So he's like, well, if I finance at a higher rate, will I get more off? They're like, yeah, finance at a higher rate. Great. We'll give you, $2,500 off. Well, he's like, well, sign me up. Let's do it. And he confirmed that there's no penalty for early payment. So he got the reduced sticker price, and a couple days later, paid the whole thing off. Right? So don't go in there thinking this is I made my decision. This is the only way I'm doing it. You're making decisions now from a position of strength because you can do that if you want, or you can play their game and, use them as a tool instead of being a tool.
Oh,
Hey-o. And that's what he did. It was awesome.
yeah, it's great. Again, just being in a strong financial position, liquid, right? It gives you that ability to just think, right? I love that story. I don't think you should tell them that you are going to pay cash though, ever. I don't think you should ever walk in and say, I'm going to pay cash.
No, you should keep that until after, towards the end.
You got to say, what do you got for me?
What do you got for me?
If I use your financing, what do you got?
Yeah.
See what they got.
Yeah, don't show your cards. I made the mistake. I remember I walked in when I was a junior in college at the Air Force Academy. They give you this, USAA gives you like a $20,000 loan at 1%.
Yeah.
It's like, congratulations, you're stuck because as soon as you walk into class your junior year, like you're committed. So they know 99% chance you're going to graduate and you're going to be in the military. You'll be able to pay that loan back. They give that to you at 1%. So it's free money, essentially. And everybody goes to buy a car with it because you can't have a car until you're a junior also. So I walked onto the used car lot, and the guy's like, what are you looking for? I was like, anything 20,000 or less. And he's like, well, let me show you what we got. And he showed me something that was $20,000, right? That was a big mistake. So yeah, don't show your cards. The stuff they don't teach you in school, man, how to negotiate.
Right.
Yeah. So let's talk about, Stephen brings up getting into real estate. Let's talk about investment opportunities. So that's another big thing a lot of people do with their cash value is say, hey, I've got my emergency savings. I'm not going to go below that, but anything above that, I'm looking for opportunities to put that to work. And Paul and I have done a number of deals together, a number of deals on our own, and mostly with private individuals. So how do we determine, like, what are some factors you got to take into account when you're determining what the terms are of that deal? One of the big ones is cost of money, right? What's my cost of money?
Yep. And I think maybe a 1.1 is, what are the odds I'm going to get my capital returned to me?
That's actually the very first thing is what's my,
Yeah.
I even have it written down, return of capital.
There you go.
What's my return of capital, plan here?
Yep. And, I think we've both evolved over the years, guys and gals, of things we did 6 years ago or 3 years ago wouldn't do now.
No, wouldn't even get me on the phone
Nope.
to entertain it.
And I think being an IBC guy, that's been the difference. The more capital I've accumulated in these boring, guaranteed, private whole life insurance contracts, the less interesting other things have become. Not that I'm not doing things, we are, but other things become just less interesting over time. The FOMO vanishes out of your life, and that's a good thing. Fear of missing out, in case you don't know what that is.
Right. So, but let's talk like numbers. If I'm looking at numbers,
Yeah.
obviously I want to know what's the cost of my capital. Because even if you have your money sitting in a savings account, there's a cost to using your capital that people don't take into account, where maybe they're happy to get a 10% return on their money because they don't think that their money is costing them anything by loaning it out.
Right.
Well, for me, a 10% return, a 10%, gross return, gross interest return is not going to cut it, because after you take in the cost of capital, I want more than that.
That is my cost of capital.
Sure, you could round up and say 10% is my cost of capital.
Yeah.
But, I was going to do an example here, something real simple, like everybody talks return on investment. What's my return on investment? Well, there's a simple equation for ROI. It's basically what you made over what it cost you. So what you made is your net return. And what it cost you is, what it cost you to use that money. So in our case, it's a really simple equation when it comes to borrowing against your cash value. And this is probably an overly simplified example because it doesn't even take into account you're making loan repayments during the time of that investment. But if I want to do an ROI on my investment, let's say I'm going to invest $10,000 in my neighbor Bill's food truck business he's just starting up. And he's telling me I'm going to get 10% on that. So what's 10% on $10,000 over a year? $1,000, right? Okay, so that's my net return. I made $1,000. But what was my cost? Well, if it was my money and I took it out of a savings account or a checking account, my cost is $10,000. It cost me $10,000 to make 1,000. Wes, what is your cost if, let's say, the interest rate is 7% from the insurance company and you borrowed $10,000 for 1 year? What is that going to cost you?
$700.
Exactly. Because what's the only thing you had to come up with? $700 to pay the interest on that loan, because that wasn't your money. Your money is still safely residing as equity inside your policy, earning uninterrupted compound growth. So we didn't even take that into account, what you're earning on that $10,000 inside your equity of your policy. So we're just ignoring that. So now if I netted $1,000, so that's a 10% return. You know, most people would say, oh, 10%. Oh, but it cost me 7%. So really I only made 3% on my money. That's what the layman thinks. They just look at the spread. 10 minus 7. Hey, I earned 10. I paid 7. I got a 3% return. Well, that's dumb, Dave. Why would I ever invest for a 3% return? Well, let's do the actual math. My net return is $1,000. That was my profit. It cost me 7. So $1,000 divided by $700 equals what? I'll do the math for you. 1,000 divided by 700. If you're driving right now, don't do this. Comes out to 1.4285. So what that means is that's a 42.85% return on your money. Return on investment. What it means is I spent 700 to make 1,000 in a single year. So it's as simple as actually getting out your ROI calculator. I tell everybody, download this app, Easy Calculator. Easy, like the letters Echo Zulu. It's free, which is why I have it.
Right.
And go to ROI calculator. Original investment, 700. Ending investment, 1,000. Term, 1 year. Calculate. My return on investment is 42.86%. So that blows anybody else's ROIs out of the water when they're talking about, I did this real estate deal and I made 12%, or my market, you know, my ETF made, 10% this last year. Cool, man. I made 42. How you like them apples? Right? Because you're not using your money for this investment. The only cost to you is the interest. And you're most likely repaying that loan throughout the year anyway. Even though you know that money's going to come back to you at the end of that investment period, if you did your due diligence right, and you get return on your return of your capital. At the end of the year, you're going to get that 10,000 back. But in the meantime, you've been making loan repayments with whatever extra cash flow you have every month. And what I found when most people do this, they call me and they're like, Dave, I've repaid my loan entirely and I haven't even got my principal back from the investment yet. What am I going to do with that when I get it back? Because I don't have anywhere to put it because I've already repaid the loan. Yeah, I said, well, you started too small, didn't you? It sounds like you need another policy.
Huh. That's always the case.
Yeah. But how cool is that? That didn't even take into account loan repayment. So you're actually paying less than $700 in interest because your volume is going to go down. And then the
dividends. Growth of the policy.
The growth of the policy. Uninterrupted.
So Page 69, guys, and Becoming Your Own Banker, 5th edition. That's where Nelson kind of gives that example. Even though that IBC is not about investments of any kind, he kind of gives you a little example there. And he goes through like the traditional way out of a savings account, and then using the IBC way, and he reminds us that, hey, don't forget your policy also grew. Yeah, you paid interest to the life insurance company. Yep, absolutely. But you also got guaranteed growth and dividends at the end of the policy year.
Yep.
Which enhances your return, which creates a tailwind in your financial life.
Yeah, and Stephen comments, savings account pays 1%, the loan and loans it back to you at 6%. They're not just making 5%.
It's a lot more.
They're making a lot more than that.
Yep.
Yeah.
Yep.
So that's, I mean, when it comes to opportunities, that's how I view it. And if I'm paying 7%, maybe I want to make 17% so that I'm getting 10% above the cost of my money, even though that kind of return would be a lot greater than just, earning 10%. As we just showed, it's not just what I earned minus what I paid. It's a lot more beneficial than that.
Yep. Bottom line, it's all about managing risk when it comes to, evaluating what you're going to do with your capital. But I tell you, the older I get, things become less interesting, and if I'm going to do something, I'm damn sure that I'm going to get return of capital.
Yeah.
Before I do any of that math that Dave just did for us. That's how I'm thinking about it.
Right, that doesn't matter. Not until my return of capital is secured.
And that's how the banks think, right? Even though they're creating money out of nothing, which we cannot do, unfortunately, or I guess fortunately, right? We don't want to contribute to inflation. But that's what they're doing. That's why it's easier to get a mortgage on an existing home, unless you're self-employed, right, Dave?
Yep.
And it's very difficult, than something that doesn't exist yet. Construction loan, right? Totally different underwriting. Because there's nothing to protect the bank. It's just a piece of dirt, but nothing on it. So they evaluate risk first and foremost.
Yep. Along those lines, I was talking to a client this morning actually, who was saying he's got a couple vacation rental properties. One of them's a condo in Destin, Florida. Well, taxes and insurance only go one direction, up, especially in Florida when you're talking insurance. They basically doubled. So what used to be a pretty good moneymaker, now he only nets about $750 a month on that condo when all is said and done. So he's cash flowing $750 a month. Well, he said that condo is fully paid for, and it's got a market value of $600,000. And he's like, when I do the math, $600,000 earning me $750 a month doesn't sound like a very good return. I'm like, because it's not. Yeah, it's terrible. Yeah. So now he's exploring, well, maybe there's a better use for that $600,000. And I'm not saying he's going to take it out and put it through a policy, but he's starting to think like a banker. Like, it's basically like looking at what you have and saying, if I was presented this opportunity today to pay $600,000 to earn $750 a month, would I take it? And if the answer is absolutely not, then maybe I should reevaluate my position here and look at other options.
Yeah, and that's exactly what I did fairly recently. I had a bunch of single-family rentals that we offloaded the last few years. Offloaded this house. Could have rented this house easily, right? It's in a great location for people that commute to the Pentagon or DC, wherever they want to go, or south if they work south of here. But the cash flow that I could make on it wasn't worth it. Let's say the cash flow would have been, $400 a month, roughly, right? The minute something breaks, right, like something major, well, I just ate into an entire year of cash flow. But the equity I had due to appreciation and just, paying down the note over 4 years I needed that lump sum of money far more than I needed $400 a month of cash flow. It would have taken the rest of my life at $400 a month of cash flow to get the money that I pulled out of this house. Right. So that's kind of how I think about stuff like, oh, people get cash flow. Like the lump sum of cash was far better for us in this position. It would have been far better for anybody, actually. So Paul asked a good question. Can we jump to that?
Yeah, go for it.
Yeah, so Paul asks, what percentage of your cash value do you keep available? Do you have a floor percentage? So I think that's a solid question. No real wrong answer. We know people that keep themselves completely leveraged, which not us, people do. I in the past had talked about having 1 year's worth of premium available always as a reserve, right? So if your premiums were $10,000 a year, you want at least $10,000 of cash value. That's your floor. And we've talked about having, 5-figure emergencies. Nothing's ever, no one ever has a $500 emergency. It's always 10,000 bucks or 20,000 bucks, right? It's not, oh, the water heater and the AC went out. Well, there's $15,000. Great. But now I'm kind of evolving, I think, right? And that's the beauty of this. The policy, all of our policies, right, are getting better every single year, no matter what we do. All we're doing is feeding it premium, repaying loans, feeding it premium, and it's growing, contractual, good dividends. It's great. So I'm kind of I've upped that now that I have more cash value available. I've gone from 1 year of just premium to just like a percentage of, and that percentage is currently 100%, but that's obviously ridiculous. So I think it's gonna be based on your personal situation, Paul. Like your situation might be different than mine, different than Wes's, different than David's. So I can't really give you, but I think, 1 year's of premium based NPUA is a good place to start at least. Whatever your emergency fund, and then on top of that, your emergency fund in your policy at all times.
I think that's a great, and I don't think I've heard you say that before, but I think that's a great, I would say, I mean, the common conventional wisdom out there is like 3 to 6 months worth of living expenses, what I think is fine. And the more cash value I accumulate, the more months of living expenses I want to actually keep as an emergency fund. So if I could do 1 year's worth of premium, full premium, plus 6 months worth of living expenses, maybe that's my emergency fund. And anything above that, I'm looking for opportunities, or I'm accumulating it to finance the next big ticket item.
Yeah, because as we saw in 2020, right? A lot of people were not allowed to go to work and labor for a wage. They were locked up in their homes, right? And people literally lost their livelihoods because of that, right?
Lost their
And
minds.
that's
too.
unfortunate. So that got us thinking, right? And they lost their minds. But that got me thinking, well, I don't want to be in that position. I always want to be in a position where I can kind of weather the stupidity, whatever that is, whether it's, a natural disaster, which is what that was in 2020. It was a national disaster. It's embarrassing, right? But everyone's going to be different. 20 years from now, what you thought you needed today is going to be totally different because your policy is going to be 20 years older. You're going to have 20 years worth more premium growth and dividends. So it's going to be a moving target. And the thing is, you can plan on that. You know what it's going to look like.
Yeah.
With a fair amount of certainty. You know what it's going to look like.
And after Paul's experience with building a house, I know my wife and I want to build a house in the next few years. My number is shot up dramatically. And I say, I want to have this much liquidity when that time comes. And that's the number I'm shooting for. And I'm going to keep it there until that happens. And then at that point, maybe I'll evolve. I'll reevaluate and say, maybe I don't need to have that much capital available. I mean, there are people, though, that are It's almost like they're addicted to leverage. Where I mean,
Yeah.
I use real estate investors as a pretty common example, where most of them are cash poor, dead broke, because all their
That's
money's
what I
out
was
working
thinking
for
of.
them. All their
Yeah.
money's in deals, which is great. But what happens when there's an emergency? Now you're going into debt. Now you're paying, 29% interest on a credit card.
And unlike Hans Gruber from Die Hard, none of these guys are sitting on a beach earning 20%. They're
No.
all too busy to get life insurance, apparently.
Yeah. Or too impatient. We've got
You
we've
guys
got a
get that
few.
quote? Die Hard, we'll sit earning 20%. Okay.
I gotta rehack my currency on that movie.
Oh man,
But yeah, so having cash just feels
Clark
good.
got it. Yes.
Yep.
Yep. As you say, it's if you have enough cash to solve a problem, you don't have a problem.
Yeah. True. Sure helps you sleep better. Lone Star. Steven says Paul looks like Lone Star from Spaceballs.
Coming out with a second one.
Nuh-uh. That's great. They're coming out with a
Yeah,
Happy
they are.
Gilmore
And
too.
Mel Brooks, who's going to be, yeah, Mel Brooks turning 9 is going to be, what's his face there with the liquid Schwartz? What was his name?
The Darth Vader
I'm having
character.
a brain fart right now. No,
Dark
he's like
helmet.
the little,
Oh,
He's like a Yoda.
he's yogurt. Yogurt.
Yogurt.
Yeah. Yeah.
Such a good movie. Anyway,
Classic.
great.
All right. Well, that's probably a good place to wrap it up then. Unless anybody's got any final comments or questions, we can wrap her up.
Hey, I was just going to say to Paul on the baseline, something that's simple for my kids to try to understand some of this. I told them, hey, start with 50, start with 100, get to 500, get to 1,000, get to 10,000, whatever it is. And I actually had a proud moment the other night at graduation for our youngest. He graduated high school. And he told that to one of his friends that he was stressing about something for his truck. He said, hey, man, we just graduated. You can get a job, make your baseline 0, then go to 500. And I had no idea that he actually heard that and retained it. So
That's
something
cool.
simple, start small, right? And then get there and then keep going up from there. Baseline, your new 0 is 100 grand, whatever it is, doesn't matter.
That's
500 grand.
right.
Yeah.
Exactly. Your
$100. Who
zero is,
cares?
yep. Your 0 is going to move. That is, I love how you said that. That is exactly how we think about it. Like, this is my baseline. Everything above that is opportunity, emergency, whatever. More opportunity than emergency, I
Or
guess.
new
But
rims for
I
my
love that.
Audi A4. If you're my son,
Right.
always something. Always something with the car. Awesome. Thanks, Wes. All right, everybody. Well, hey, thanks for joining. We hit about 1 hour on the dot. So we'll see you guys back here next month. Enjoy your summer. And until next time, control your capital.
Or somebody else will. Hey, thanks for listening, everybody. If you'd like to have a conversation with us to see how you can become your own banker, or if you have any questions or topics you'd like us to tackle in a future episode, please send us an email to davidandpaul@theibcguys.com.
And subscribe and leave us a review if you're on Apple. Follow and leave us a 5-star review if you're on Spotify. And please share this with your friends. We'll see you next week.